talking about. So in this case, when I say the stock market, we're going to use the S&P 500 as our benchmark. That's the 500 largest companies here in the U.S. And what you're looking at on the slide, those gray diamonds are what we call the intra-year declines. So every year, how low did the market go in that year? And then the blue graph is where the market ended. So if we go out to 2019, you can visually see we had a 7% pullback last year, and then the market ended up 29%. So having volatility in the stock market always is normal. The good thing is, more often than not, even though we have volatility throughout the year or these intra-year declines, usually the markets do tend to end positive. Now, the difficult part about volatility is it's unpredictable. So John and his team, there's no possible way they can reach out to their clients ahead of time and say, okay, everybody, February 1st, we're going to have a recession, let's get to cash. It's completely unpredictable. But the good thing for investors is all volatility is cyclical. So whether it's a pullback, a correction, or recession, the markets will react in the same exact way. Now, if you hold up in front of you a peace sign, or maybe the letter V, I don't think you're going to feel too much peace during volatility, but if you hold up the letter V, that's exactly what a pullback, a correction, and a recession looks like. Markets come down, they bottom, and they come back up. Now, visually on the slide, you can see exactly what I'm talking about as well. Now, this goes all the way back to 1940. The blue lines are periods of up markets or your bull markets, and then the red lines are your down markets or your bear markets. And you can visually see that series of V's taking place over time throughout the history of the stock market. It's unpredictable but cyclical. Now, the positive about this is a couple things. Number one, the up periods in the market of the blue lines, they're much more frequent and they last longer than the red lines, which are shorter and less frequent. The other positive is you can visually see over time this line is going from the bottom left-hand side to the top right. So you're seeing you're making money in the stock market even though these bouts of volatility can be normal. So one last thing on this, just like the catalyst for volatility is unpredictable, we also can't step in and tell you when the bottom of the market has occurred. Now, for those that were investing in 2008, 2009, you might remember how you felt. Maybe you've picked up the phone now for the 10th time to call your financial advisor. You know, everyone's saying go to cash. You're nervous. You're seeing signs to buy gold. You know, that usually triggers our bottom. And then there's the other side of the V, and it can happen very quickly. So in 2009, the official bottom was in March. In only 6 months after the market bottomed, the S&P was up 54%. In 12 months, it was up 70.2%. So it's incredibly important that you remain in the cycle, because if you come out of the market mid-cycle and do not re-enter, you usually miss a significant rebound, which tends to occur right after the bottom has happened. The next thing I want to walk you through is the concept, and try to remember your best, that the easiest way to make money in the stock market is to buy low and sell high. Buy low, sell high. One famous investor, Warren Buffett, he has a motto: I get scared when people are greedy, and I get greedy when people are scared. And essentially all he's talking about is I buy low and I sell high. Now, logically in life, this makes sense with everything. I'll give you an example. Let's say I was to go to the grocery store, and let's say I'm in need of toilet paper. Many of you might be able to relate to this. And I go to the toilet paper aisle, and there's a package of toilet paper, and it's $50 a pack. And that's incredibly expensive. So I wait and I go back next week, and now it's reduced. It's on sale for $25 a pack. Perfect. I buy something for cheaper. I buy low, and I feel good. The same is true when I sell something. I want to sell something for the highest price I can possibly get, and that makes me feel good. When it comes to your own money, that logical concept unfortunately goes away, and emotions tend to step in and cloud your logic. This is what happens. Let's say you get your first statement in the mail, and I'm going to use real numbers. Let's say you have $1 million invested and your portfolio is down 20%. That means on paper you have a $200,000 loss. That's frightening, right? So this logic of buy low, sell high goes away, because emotionally I'm seeing these numbers. I pick up the phone, I call my financial advisor, and I say, I cannot take it anymore. I want to get out of the market today before it goes down. We sell low, but it makes us feel relief. We feel better. And then we wait, and I'm going to go back to our previous slide. We wait till we're back in those blue lines, and the markets are good, and the economy's good, and everybody's comfortable again. And we call our advisor, we say, we're ready to buy back in. We buy high because emotionally it was more comfortable to do so. So only in investing do clients demand to pay a higher price for their stocks because it feels right. Now, visually, what you're looking at in front of you is exactly what I'm talking about, and this is what investors tend to do over and over again during market cycles. So the blue line, the light blue line, again, is the S&P 500, and those darker blue flows, those are people buying or selling. So those darker blue mountain shading is us buying stock or selling stock. So if we go back to the late 90s, all the way on the left-hand side, that's when the markets were up, right? This was the tech was doing phenomenal. So you see that blue line is up, and so are flows. So market is up, and we are buying. Then if you go down to 2001 and 2002, that was the tech bubble that burst. The market went down, and people began to sell. Then you go into the early 2000s, and we had our recovery cycle. The market is up. We are buying. And then look what happened in 2008, 2009. The market went down, and we're selling. So we're selling low and buying high over and over again. Now, one analogy I want to provide you that I'd ask you to share with others if they're making these investment mistakes over and over again will really help you understand this concept. So before I use toilet paper, I understand that toilet paper and your investments have nothing to do with each other. So I would like to compare it to something that I would consider a very important investment. So your LPL statements, your 401k, your IRA, your brokerage accounts, those are investments. Would we also agree that your home, if you're a homeowner, is an investment? Sure, right? Well, could you imagine if I knocked on your door one day and I said, I'm so sorry. The housing market's going down, and it's going down really fast. Your house used to be worth $500,000. I have it valued at $400,000. Would you ever say, well, Emily, I cannot take any more loss in my home value. I will sell it today for $400,000 before it goes down more. Then you wait. I come back and I knock on your door a year later, and I say, great news, that house you sold for $400,000, well, the real estate market's back up. It's now listed for $500,000. Do you want to buy it back? No, right? That's absolutely crazy. You would never make that decision. It sounds so illogical. You would stop a friend or family member from doing that. It makes no sense. I promise you, it's the exact same thing when it comes to your investment accounts. Now, it's trickier with investments because you can't live in your LPL statement, right? But you also don't have a ticker on your house telling you the value every single day. We have to remember that investing specifically in the stock market, just like the real estate market, is a long-term investment. And I'm going to bring up this slide to really kind of drive that home. So I think we're very immediate as a society today. We want things instantly. We can look at our accounts any point in the day, right? We're very immediate. With stock, we have to remember to take that longer-term view or extend that time horizon. So what you're looking at here is if I were to put money in the S&P 500, what is the likelihood that I'll make money given a certain period of time? So if I put money in for 1 year, on average, I've got a 74% chance I'll make money in the stock market. And that's pretty good. But look what happens if you extend it. If I hold it for 5 years, my chances go to 82%. 10 years, 91%, and 20 years, 100% chance I make money in the stock market. Your stock is supposed to be your long-term growth investment, and the longer you hold it, the more likely that you're rewarded for taking on that risk. And I always say, extending that time horizon not only for yourself, but for your family members as well. If you think about retirement, 20, 30, 35 years, and then if you plan on passing money on to your beneficiaries, your children, your grandchildren, you have to factor in their lifetime as well. And you can easily see why holding stock can be beneficial because it, again, increases the chances that you will make money. So the last slide I want to talk about is this slide here. And the bulk of this presentation has been on the fundamentals of stock investing. I acknowledge that most of you on this call are not 100% invested in the stock market. And I think one of the easiest way to stay calm is to remember where you're invested and what its purpose. And one of the reasons why I like working with John is his team has a focus on financial planning. So when they sit down and work with you, they figure out, okay, what are your long-term goals? And now, because of those goals, we're going to pick the proper investments to reach those goals. And it could be a mix of stocks, bonds, and cash, whatever it is for you and your family. Now, understanding what you're invested in and its purpose is very helpful during periods of market volatility. So one rule that I always talk about, and it's a great rule because you can use it to figure out where you should put your money and why, is the rule of 72. If you haven't heard of this, I'd write it down. It's incredibly important. So the rule of 72 is the calculation we use in our industry to figure out how long it's going to take your money to double. So if you were to work with John and your advisor and have a portion of your money in a lower interest rate vehicle, let's see what it would do for you. So let's say I've got a CD and maybe it's paying 1%. How long will it take my CD money to double? Well, if I do 72 divided by 1, that equals 72 years. So the lower the interest rate, the longer it's going to take to double. I don't have 72 years for that money to double, so therefore I can deduce that that money is meant for today. Your short-term assets, the money you need today, is not in stock. It's in those lower interest safe vehicles. And that's why I love working with an advisor, because they figure out what do you need per week, per month, per year, plus some for emergencies, and those assets go in a bucket that's not tied to the stock market. So even if we are in our 16th recession, your everyday life should not dramatically change. Now, if you've had a life event, a loss of a job, a loved one has to move home, that's different, and that's when you reach out to the advisor to tweak some of your planning. But for the most part, your short-term assets are what we should be drawing off of when the markets are down. Now, the other buckets are still in place, too. You still need stock, even though you're not going to be happy every 6 to 7 years. The purpose of stock is for growth. Let's go back to the rule of 72. If I can find a 10% return on average in the stock market, 72 divided by 10 equals the fact that my money will double every 7.2 years, right? It'll double faster the higher the interest rate. This is significant specifically for retirement. When you retire, you stop making money, right? You start to take money out. You're in the distribution phase. So a bulk of your retirement money has to be tied to assets that are doubling faster. We call it your growth engine. So visually, if you're looking at the slides, what I'm showing you is exactly what I'm talking about. The gray is a 3% return, the light blue is 6, and the dark blue is 10. We're putting in the same amount of money, and we're allowing it to grow over the same time period, and you can see the growth difference. Now, I know stock can be scary, especially now we're in a period of heightened volatility, and I often hear, well, I just don't want to lose my money. Luckily, markets are cyclical. It's always a V. I've never seen an L or a straight down. But the most important thing to remember is if you turn off your growth engine, right, it's scary to lose money. I would argue it's much more scary to run out of money. So if you're concerned, if you're worried, work with a financial advisor to kind of go back through your plan, make sure your bucket's in the right place, and that way, again, you can feel much more confident to leave your long-term investments in the place that they should be. So I'm going to take a break there. John, you mentioned you'd have a couple questions. We can kind of go away from the investment basics and now kind of go back to my first hat of what we're seeing in the market today.
Yeah, Emily, this is some really great stuff. The importance of maintaining a long-term view is crucial during these times of panic. So I have a few questions I've been getting over the last couple of months from a number of clients I'd like to ask you. So number one, is this the first time a pandemic has led to such a strong market decline, and is this time different?
Yes, so I've actually heard that question a lot as well. I would say this time is different as far as our everyday lives, right? We've been through a lot of periods of market volatility. This is certainly the first time, we're having to stay in our homes. We're worried about the health and well-being of our loved ones. Many of us have had to change our entire life schedule, to accommodate. So the situation is different. And then also the catalyst for the volatility is different. The positive is the catalyst is always different when it comes to a recession. So in 2001, we had the tech bubble burst. In 2008 and 2009, the entire banking system was on the verge of collapse, right? And fast forward today, we have a pandemic that has led to basically recession. So the catalyst is always different. I always tell investors, yes, it is different. If it was similar, we would have known in advance. The positive is even though the catalyst is different, the cycle will remain the same. The markets will go down, they'll bottom, and they'll come back. Now, there's a little bit more positive this go around. I think because we saw the stock market move so quickly, the steps that the Fed and the U.S. government did were they came in much faster than they have in previous market cycles. And I think they also had the benefit of having the playbook they used in 08 and 09 to really pull us into a recovery cycle. And we're seeing them do a lot of those same decisions, but faster this time. The other positive is because the pandemic is the reason why we're seeing volatility, the government really was able to quickly come to a bipartisan agreement of who should get money. And that was done easily because if it's a pandemic, they were able to identify exactly which people, which industries, which sectors were going to need money. Versus 08 and 09, it was a very long, drawn-out political dispute, who was getting money, who deserved it, who didn't. This go-around, their measures seem to be quicker and much more bipartisan than we've ever seen before.
Why did my bonds go down with my stocks? Typically, most clients said, typically bonds are conservative investments, and people go there when stocks, go down. But why do they go down with my stocks?
Yeah, that can be frustrating, and it happened in 08 and 09 as well. And really, to kind of explain this go around, you have to go back a few years. So the markets in general, both in the stock market and the bond market, have been doing very well. People have been making a lot of money in stocks and bonds. And when we peel it back and see where flows have been going, so what are people buying? We look at the big money, the institutions, the foundations, the endowments. They've been over-allocated to bonds for a very long period of time. And the reason for that is they're able to hit the returns they need with a relatively low amount of risk. You had an extra amount of bond purchases going into this cycle. Then as we saw the market start to soften, it was an instant dash for cash is what we call it. So corporations, endowments, hedge funds, they'll sell their bonds first to raise capital for whatever they need their cash for. And you had indiscriminate selling all at the same time. So it didn't matter if it was high yield, high quality, short duration, long duration, taxable, tax-free. Everybody was selling bonds at once. Now, normally there's a group of market makers or investment banks that are supposed to come in and be the buyers on the other end. And similar to 08, 09, they were not. They were selling along with everyone else. Nobody really wanted to be the first one to step in. And that's why a lot of investors saw their bond funds drop 6, 7, 8% in a single week. That is when the Fed stepped in. So now we're going on about a month where the Fed has come in and said, we are going to be the buyers. And they did this in 08 and 09, but they waited a lot longer. So they're going to buy investment-grade corporates, mortgage backs, tax-frees, and really every week they continue to put out these programs to stabilize the bond market. So you've seen massive liquidity return. We talk to our traders, and trading is virtually normalized. And many of you, again, if you're looking at your performance, I don't suggest looking at it in a short-term manner, but you'll see that your bond performance, again, have come back now up 10, 11, 12% since the bottom. So that was really needed to be fixed first. You needed liquidity there before we can see any more rebound in the stock market.
What areas are you most concerned with?
So I think there's some more to this cycle to go. I don't think we're out of the woods yet. In our opinion, you're really not going to start that upward trend like we saw on the slide in the beginning there until we can manage the coronavirus. So flatten the curve, maybe have a vaccine. You need people to go back to their everyday lives before we're out of this mix. In the meantime, we think you're going to see these heavy volatility, these market swings back and forth, right? If you have positive news on corona, the market seems to be up. If you have negative fundamental news, the markets go down, right? Oil's dropping below zero, or retail is coming out under worse than they expected. You're going to just kind of see this fight back and forth with volatility until we can get, some normalcy and upward with the corona under control. So that being said, we are really still staying away from high-risk assets. So high-yield junk bonds and high-risk equities that even though the prices are super attractive, just because you're cheap doesn't mean you're good. And I think there's a lot of companies that are not going to survive this, and it's our job as an investment manager, to really make sure we're prudent with our investors' capital and only purchase things that we think are high quality until this volatility subsides.
And finally, what areas of opportunity do you see out there?
Sure. So there's great opportunity both in bonds and in stocks. On the fixed income, the bond side, because you've really secured that buyer, the Fed, and now since then the investment banks are buying as well, and you're seeing trading normalize in the bond market, you've got some high quality that will municipal action bonds, municipal space, finally seeing this there that if investors don't want to on the risk of the stock market, there is some potential in income still. From the stock, I always say to investors, if you invest in the stock market, I imagine you believe in capitalism. And 6 weeks ago, you had a lot of great companies out there, but they were super expensive. You fast forward to today, and you have discounts everywhere. It's similar to 08 and 09 all over again, but we can more accurately depict how this turns out because we know which sectors are affected. So our job, again, as a money manager, is we're sifting through the companies that we believe have a mismatch in pricing today to take advantage of their performance later on. And it's those high-quality companies, names that tend to thrive and get through any market cycle. We're not allowed to name individual stocks. I think that's something that, John, you can do after the call on an individual basis. But I will tell you one sector or area. So in the stock market on the growth side, the sector that we are favoring still is technology. And it's twofold. So number one, think about yourself in the last week. What have you been doing? So currently I'm sitting on my computer on a WebEx talking to you all. My children are downstairs on their iPads. I had to put them in front of their iPads because I'm afraid they're going to storm my office. You probably Zoomed your family, FaceTimed. You probably ordered Amazon packages. You're probably streaming via Netflix. I mean, the big tech companies have thrived during this, and when we look out going forward, I imagine they're going to be needed even more. So corporate America in the U.S. has been very hesitant to do that work-from-home dynamic, and now they've had to. And I think many of them experiencing massive success. I think going forward, you'll see a lot of companies keep 20, 30, 40% of their staff in this work-from-home dynamic for two reasons. Number one, it's been very efficient in its work, but number two, it's very inexpensive. So that's going to be fantastic to their bottom line and balance sheets. But again, who wins? It's going to be the tech companies that keeps this kind of new norm going. So that's one area where you can see some discounted pricing where we think there's so much more opportunity on the other side of this cycle.
Thanks. Thank you, Emily. I appreciate the insight you've provided this afternoon, and I hope everyone has found the webinar to be informative and try to remain patient during these very uncertain times. If you would like the slides of the presentation, just let us know. We can send them to you tomorrow. And as always, please don't hesitate to reach out if you have any questions or concerns. Enjoy the rest of your afternoon, and thanks again for joining us.
The chairperson has disconnected. The conference will now end.